So I'm going to give you guys a secret, how to get the most out of your life insurance policy, or how does the rich get the most out of their life insurance policy. If you have a mortgage, particularly a joint mortgage, even if it's a single mortgage, that's okay. But when two becomes one is always good. You want to stay tuned for this video. This is physical property and liquid property, and I'm going to explain. Let's say we have Samantha, who's 29 years of age. She's a doctor. Ryan is 30 years of age. He's an engineer. They have a 1-year-old. They're purchasing their first home and its value of $1.65 million. Stay with me. So the house is 1.65 million. They take out life insurance each for 1.65 million on Ryan and Samantha. What this does is clears off the bank if anything was to happen to either one of them, so the house is debt free. But they also do additional life insurance for $1.5 million, and they do it to age 60. Now, this type of life insurance is an endowment. There's significance behind that. Let me explain. So, the value of the property is 1.65, and they now start the only bank 1.65. After 17 years have passed, the value of that property that they purchased for 1.65 will go up, underestimating the amount that it goes up by. Just keeping it simple for this video. So after 17 years have passed, let's say the property value gone up to $3 million. The amount that they owe in the bank at that point in time will be 1.1. If you minus the amount that the property is now worth, minus the amount that they owe in the bank, this amount is called equity. So the equity on the property is $1.8 million. They can leverage this equity and take out a line of credit. So the bank may be willing to lend them 80% of that, which is $1.5 million. Yes, they may still have to qualify for it, but they can use this money to invest to make more money as they prepare for the retirement, because by that time they'll be 47. Now, what about that other life insurance that they did for $1.5 million? That's supposed to be like a liquid property that builds value. Can they withdraw from that too? The answer to that is yes. Their life insurance comes like a liquid property, a property that builds cash value over time that they can access. So that $1.5 million endowment that they did to age 60, each two becomes one. After 17 years, Ryan can withdraw $500,000 and Samantha can withdraw $500,000. So they're able to get $1 million from their life insurance. And their physical property, which it is a equity fund for $1.5 million, if you combine the two, they're able to get $2.5 million at age 47. So at 47, they can access $2.5 million to invest, to buy another property, to do something. And they still have another $1 million each to collect from their life insurance. Now remember, the amount that they did it for is $1.5 million. They only withdraw $500,000. So they still have another $1 million to get at age 60. So which they can use to clear off this equity loan that they took. Don't say I didn't tell you. Now, I know some of you guys may be saying, why is this just save the money in the bank? You can't save the money in the bank. Keep in mind, that $1.5 million is still life insurance. So that if, God forbid, Ryan and Samantha was to pass away, the house would have been cleared off, and then they would have had $1.5 million to make sure that their daughter is taken care of. That is the key difference between using life insurance and then using savings at the bank. You still have your savings with the bank, but just showing how you can maximize on your life insurance. Now, this is not for everyone, but if you think someone could benefit from this, share it with them.